Hey everyone, Chris and Jason here with the Private Lenders Podcast, brought to you by our mastermind group for private and hard money lenders, hardmoneymastermind.com. Check it out, get a free account, join the conversation, and also, of course, by our lending company, hardmoneybankers.com. Okay, having a conversation today about structuring loans that you're comfortable with. Now, let me tell you where this comes from. A lot of people come into lending with these strict guideline mentalities, maybe because they've been in banking before or just because they've dealt as a borrower with traditional lenders or something like that. And they think that a loan has to fit into the exact box of guidelines. For example, like if you're 65 LTV, you take it exactly to 65 LTV. If you have other guidelines and stuff, then it's exactly that. And the reality is, in investment deals and private lending like this, there's creativity that comes into play, and also just learning from experience and learning how to get comfortable with a deal or a loan amount that you're comfortable with, not just because the guidelines say X.
That's right. That's right. And again, it's like, I feel like I could rant about this all day long because, everyone's like, well, how should I adjust for this situation? The borrower's credit score is a little bit lower than I thought, or it's like, I'm going to pass on this deal because whatever. There's always a number that potentially makes sense. Now, obviously, if they buy a property for 50 grand, it might not be worth lending any money. But, I remember speaking with a lender right when COVID hit, and he had a borrower that reached out to him that bought a property for cash for $400,000. And he was like, yeah, I'm uncertain of what's going to go on right now. I think I'm going to pass on the deal. I was like, we didn't pass on the deal. Offer him 100 grand. Like, tell him that's what you're comfortable lending, $100,000. And he was like, he didn't even think about it. He just, in his mind, he was like, I don't want to lend the guy 260, which was 65% of the after repair value, or the current value, actually, in that case. And I was like, lower your exposure, figure out the number. Now, if you can't wrap your brain around the deal, or if the characteristics of the borrower aren't good and the transaction as a whole, or the borrower, something shady, or you don't trust the guy, that's a different conversation. That's a little bit different. But in general, structure these deals. I mean, I'll be honest, I couldn't tell you the last time we did a loan of 65% of the actual after repair value of what it actually sold for. They're typically a lot lower. I mean, we're willing to lend up to 65% of the after repair value of what we believe is the after repair value. And that's a kind of a different conversation. We've gone over this in different videos of how to structure and determine values of properties. But my 65%, your 65%, the borrower's 65% might be a different number, right? I might think it's worth 200. They might think it's worth 225. I'm going to lend 65% of what I think it's worth, or what we think it's worth, or how well they can execute. And it's not just based on comps and the value, it's how well the borrower can execute. If they're a first-time investor, they're probably not going to sell for top dollar, right? And if they're a seasoned investor, has done lots of deals, and we're in a market like we're in now, they might sell it for more than market value. So you got to take all of that stuff into consideration. But the key thing related to where we're trying to get is structure the loan that you're comfortable with. If it's an asset you don't like, if it's in an area you might not like, either pass on the deal or structure it accordingly of what you are comfortable with.
Yeah, and if the borrower asks you why, that's the exact answer. This is just where we're comfortable, right? It doesn't have to come from some exact formula. A little while back when we were starting our expansion into another market, and our partner Ian came on, I remember that he came at this with the mentality that we're talking about, and he would do the calculations based on, like, we do our own internal valuations, and then he would do 65% of what we as a company believe that property is worth, and it would come out to like $163,250, right? Because if you do the calculation, that's what it comes out to. And I'm like, what is this 250? We don't do 163. Like, give him 163 or 65 or 60. Like, where does this come from? He's like, it's 65%. I'm like, all right. And there's nothing wrong with that. I'm just saying, like, that's part of something that happened when this conversation came up. I'm like, just lend them what you want. Like, if you're at exactly 163, so often, you can start with a conservative quote, depending on who you're talking to and how strong they are, and go from there. But oftentimes, really strong borrowers aren't necessarily looking for the max leverage. Do something you're comfortable with. If your exact calculation comes to 163, 250, quote him 150.
Yeah.
150 loan amount, see if he goes for it. She, right? And then go from there. Like, this is money that you control, or some of your own money. You're making the decisions. You're responsible for this. You're going to service it. Do what you want, right? This is not, we're not reading a a loan guideline matrix like we did back in our banking days and saying, okay, well, based on this value, we can lend you exactly this to the
Yeah.
$100,
And let me tell you, you start doing loans with funky numbers, 163.50, you're going to drive yourself crazy because you're going to have a capital investor in there with a funky, invested capital. It's a mess. So let's go through a little bit. We might as well talk a little bit about scripting on some of these, because I do get this question a lot from some of our consulting clients as well as our partners in other markets of like, how would you phrase this? They think our numbers aren't great, or they don't agree with them. Like, they'll always be like, what comps are you looking at? Type of things. And you don't want to piss somebody off, right? So you want to be transparent with them. And the easiest way to typically say this is it's just an area I'm not comfortable in, or I can't wrap my brain around the value of the property. And you don't want to insult them and be like, they think it's worth 300, you think it's worth 200 type of thing. So tell them, it's like, hey, listen, honestly, like, I'm having a hard time wrapping my brain around this property. It's an area that we don't know really well. We only lend in areas that we're comfortable with, and we lend. It has nothing against you. It's just I'm having a hard time with this deal. I really want to work with you. I want to figure out a way to make it work. I'm just having a hard time with it. So, I don't disagree that it might be worth 300. I'm not sure. Maybe it's worth more. I'm just not sure. And, I'm not a bank. I'm a private lender. So I want to lend. We only can lend what we can wrap our brain around. It's a little bit outside our box. So I'm not saying like, just be transparent with them. Tell them what's up. I'll give you an example. So there's a deal in Baltimore City, which we don't do a ton of stuff in Baltimore City, and it's a commercial transaction, and a 7,000 square foot property. The guy rents out next door for about a third of the square footage for about $5,000 a month, and he's buying this for his business, and it's 7,000 square feet, right? So inevitably it could be worth a lot more, and he's buying it for $425. He said he got a bank appraisal for $445. The bank was going to give him a loan at 90% of his purchase price, and that fell through. He came to us, and I was like, listen, this is kind of outside of our box. It's a vacant commercial property too. Currently, he still has to build it out. And I was like, I'm not stating, and in his sense, it's like, well, I got an appraisal. This is what it's worth. Like, that's what he had in his head. And I had to kind of go through, and I did this multi-steps instead of one step, just to kind of, it made it a little bit easier. And so it didn't look like I was insulting him. And the way I phrased it was, honestly, this is a little bit outside of our box. I understand what he's trying to accomplish. It's not really an area we do a lot of stuff in. It's a commercial property that needs work. Like, I don't fully want to insult you with our number, but like, you're going to need a lot of cash if we do this deal, type of thing. And he was like, yeah, I understand. And I was like, it might be like 50 LTV. I'm not of his purchase price. I'm not 100%. I'll get back to you. So anyways, I quoted him $150,000 today, because that's what I was comfortable with. And some might be like, you're not even looking to write loans at those numbers. Like, that's, but like, that's what we were comfortable with. And I told him, I was like, listen, this isn't going to be a great fit for us. We're only going to be at 150. I understand that doesn't work. If for some reason something changes, feel free to reach out. So like, I'll tell you, I talk to a lot of people every day, and I turn down a lot of people, not turn down, but I quote what, I'm comfortable with every day. And I get very few people that kind of, are pissed off about it, because I can phrase it the right way, in the nice way. People will be like, well, I don't, what's wrong with the property? What's wrong with the areas? It's like, it's just not for me. It doesn't work. And, we're in very, we get to see a lot of different opportunities in different markets, right? Because we have DC, we have Baltimore, very different markets, and we have the Philadelphia, then we have Northern New Jersey, right? So they're all very, very different markets. And, there might be a property that is in Baltimore City that doesn't have a lot of value, but it has a very high income approached value to it. So it's not uncommon to buy a property that's has a tenant paying $1,400 a month that you can pick up in livable condition for $80,000 in Baltimore City, right? So if you look at it as an income approach based on different cap rates, one might think or state that it could be worth $1,200 or $120,000, $150,000, but on a resale value, it might only be worth $50,000 or $60,000. So we tend to shy away from those particular deals. And I explained to them, it's like, listen, for you as the operator and the rental property owner of this property, it seems like it's a great deal for you, but as a lender, it's tough. And we try not to go too in depth of why, but like we've talked about this on other videos. If you do a 65% LTV on $100,000, you have a lot more risk than a 65% LTV on a $300,000 loan, because you only have on the smaller loans, there's more risk. That's just what it is, right? You only have you still have 35% equity, but you only have $35,000 in cash equity. And on a higher loan amount, the $200,000 loan on a $300,000 ARV, you have $100,000 in cash equity. So, you know, I try not to like go down that road too much of the reasons why to a borrower, but I just tell them that, you know, unfortunately, it's just not something, you know, we're comfortable doing, or I just throw out. And I don't want to use like a lowball, use the term lowball, although that's what it is. And it's not like I'm throwing that out. Like there's rationale and reasoning to my, you know, to why we're quoting and lending based on what we're comfortable with. But that doesn't mean that, you know, they need to know all the behind the scenes.
Yeah, totally. I mean, that's what scripting is for. Exactly right. Like positioning stuff in the right way. And now that we're talking about it, and I was thinking during the conversation, and I don't think that we've ever gone above 50 loan to value as is value on a commercial property.
Yeah, could be.
Above 50? I don't think.
I don't know.
For example, the one that we're closing this week it's a retail property, single unit retail property in Georgetown, DC. So this is some of the most valuable real estate on Wisconsin Avenue in Georgetown, DC, some of the most valuable stuff in our whole footprint, our whole lending footprint. And we're still at probably a little under 50 loan to value.
Yeah.
And again, the same thing. It's just what we're comfortable with. It's just what we do on properties like this. Works perfectly fine for the borrower as well. They weren't at all annoyed by that number.
Because a lot of people don't want full leverage. Like they might say they want full leverage. I talked to a guy today that his capital. Exactly. He was like, he said, I need 700. I'm buying it for 500 and I need 200 in construction. So I need 700. That's just the way he phrased it. That didn't mean that he wanted the 700 from us or was expecting to get 100% financing. That was just the way that it was set up. So, I mean, I don't know how we're going to structure it, but, and I don't know, maybe we've gone higher on some more commercial deals. I don't know. It's hard to tell. You know, I'm not 100% sure either, but in general, to sum this up, just structure the loans you're comfortable with. And if you can't wrap your brain around it, you don't have to do it if the deal doesn't work, right? Or if you don't want to make it work, like it's fine. But like there's lots of deals that will come in at like 20, 30, 40, 50 LTV because that's what we're comfortable with. And, you know, you got to sleep well at night. You know damn well that if you don't structure the deal correctly, it's going to be harder to get capital to be involved in the deal with you. You're going to run into more issues. So I think too many people are concerned about the borrower being upset with you. Well, don't worry about that. If you structure it the right way, or you communicate it the right way, the borrower's not going to be upset with you. Like they appreciate that you're trying to help them any way that you can to do it, but you got to structure it. You got to make sure it's presented correctly.
Yeah, and in addition to that, I think you said like they'll appreciate when you give them reasoning. Here's why. You know what else borrowers appreciate? When you're the actual decision maker and boss and owner of this company and loan portfolio, because a lot of the other people they have to deal with, like in the bank lending world or maybe the institutional lending world, are taking orders according to someone else's guidelines, right? They're not decision makers. So when borrowers, especially sharp ones, especially very savvy operators, they respect the fact that you're making the call, that you're in control of the situation. And so, yeah, like Jason said, they appreciate it. They're not going to be mad at you. They're going to be, appreciative of the fact that you're in control and here's why and here's what you're comfortable with. And it makes for a good business and a clean portfolio. Yep.
All right, guys, certainly appreciate you tuning in. Make sure to, let's finish this conversation, hardmoneymastermind.com. If you're not a member of Hard Money Mastermind, it's completely free to join. Hop on, ask any questions, chat. We got close to 100 private lenders and hard money lenders throughout the country currently on that platform. And we're trying to grow it as a free service to the community and hard, aspiring and and experienced hard money lenders and private money lenders. So let's take the conversation over there. And if you have any other questions, reach out to us on hardmoneymastermind.com, and happy to chat.
We're there every day interacting with people. So drop in and say hello. Thanks guys for checking it out.